This is not financial advice. I'm recording my thoughts about Bank of America. In full disclosure, I do own Bank of America stock. In this video, I'm going to talk about Bank of America's financials, future valuation, and also the reason why banks get a very low PE or a multiple. When I look into the stock price, Bank of America is currently trading at about $28 with a market cap of about $224 billion. The net income for the past 12 months is about $27 billion. And the PE ratio is about 8.42. Typically, banks trade at about 10 PE. Bank of America pays about 87 cents a share per year dividend, and that represents about 3.09% dividend yield based off of a stock price of $28.16. Let's first talk about Bank of America's recent earnings. They grew their revenue by about 9.18% year on year, and look at the net profit margin of 32%. This net profit margin is in the Microsoft territory. Microsoft makes about 35% net profit margins, and even the other FANG companies do not make 32% of net profit margin. So we can conclude that Bank of America has very high net profit margin. And now you can say that maybe it's just because of one quarter, right? So let me show their net profit margin for the past 5 years. In 2022, their net profit margin was 29%. 2021, it was 35%. 2020 is an odd year. It's at 21% because of other expense or income of about $11 billion, as you can see on my screen. So 2020 is an outlier, but 2019 they had 30% and 2018 they had 31%. Like I said, this net profit margin is extremely high, and it's in the territory of Microsoft and Adobe, etc. So this net profit margin is better than FANG companies. Now let's look at another metric, which is stock buyback. Let me show you a formula of stock price, and the number of outstanding shares is in the denominator, which means that if the number of outstanding shares become less, then the stock price will appreciate. So with the net profit that Bank of America is earning, they're buying back shares aggressively to help the shareholders. As you can see on my screen, in 2018 they had about 10.2 billion outstanding shares, and in 2022 they only have 8.16 billion outstanding shares. So that's about 20% reduction in about 4 years. So that's almost 5% year on year buyback, which most of the FANG companies do not do. Now let's look at the book value. Book value is also known as common shareholders equity, which is derived by deducting the total liabilities from the total assets. That's standing at about $252 billion. But now the market cap at $28 is about $220 billion, right? The stock is trading below book value, and banks typically are traded on book value. So even on a book value basis, at the moment, Bank of America is undervalued. So in conclusion, this is a company that has net profit margins in the order of 30% plus, which is better than the FANG companies. They're aggressively buying back shares. As you can note from what I said, they're buying back more than 5% of outstanding shares each year. If it were FANG companies, they would get a multiple of 30 or 35. But we're only paying a 10 PE for Bank of America. In fact, it's less than 10, right? It's about 8.52 or so. So what is the reason for that? Why do banks, being very profitable, buying back shares aggressively, still trade at a PE of 10? The reason why banks have very low multiple is because of two major reasons. The first reason is lack of moat. Banks do not have a moat. We can always pick another bank, and nobody is proud to say that they're banking with a certain bank. If the interest rate offered by another company is better, people will just move their money from one bank to another bank. So, and the second and most important reason is the assets minus liabilities, which is the book value. Let me show one more screenshot. As you can see on my screen, there are assets in the green box and liabilities in the red box. Total assets for Bank of America are about $3.05 trillion, and total liabilities are about $2.778 trillion. So when you deduct the total liabilities from the total assets, you get the book value of about $273 billion. In the assets, if you look carefully, there are cash and cash equivalents of about $230 billion, banks do have some regulations. They cannot take all the depositors' money and invest it somewhere. They have to keep some cash for daily operations. If you look into the other items within the assets, you can look at debt securities are about $862 billion. That's a major item, right? And another item is loans and leases. That is about $1 trillion. So almost $2 trillion are in loans and leases and debt securities. Now let's look at the liabilities. Deposits are the liabilities for banks, right? Because we put money as a deposit in the bank and the bank has to pay it back to us with interest. So deposit become a liability for them, right? And there are short-term borrowings, debt, and all other liabilities, etc. So here is the problem with the assets. When you look into the loans and leases of about $1 trillion, it contains commercial real estate loans, residential loans, and also personal loans. In a recessionary environment, there will be a lot of loan defaults, and that's going to impact the fair value of the loans and leases. For example, right now it's shown that $1 trillion of loans and leases is shown as asset, right? But what if a big commercial real estate company or a lot of individual folks default on their residential payments? Then what happens to these loans and leases? If they're not getting their money back, then they have to write it off. And even if there is a collateral, let's say someone defaults on their loan on a house, the bank has to sell the house to recover the rest of the amount, right? But they may not get the entire money back when they sell that house. And another thing is, when you have personal loans which do not have any collateral, if a person loses their job, they just simply do not pay back the money and the bank can do nothing about it because they cannot seize anything because it's an unsecured loan. In commercial real estate, I personally know a company which purchased about 5 or 6 buildings in the downtown and they are empty. And now they are defaulting on their payments. So obviously the bank who loaned money to that commercial real estate firm is going to take the hit because the company will simply leave the buildings and default on it. And the burden is on the bank to sell those buildings or lease the buildings again to get the money back. So loans and leases are very high risk in a recessionary environment, and you can lose $300 or $400 billion in a matter of months. So the assets part of banks is very, very fickle. And let's look at the debt securities. They have about $860 billion, right? One of the example of this debt security is a long-term bond. As we know, when banks get a lot of money as deposits, they have to put that money somewhere, right? So they'll take some of that money and put it in a long-term bond. So short-term bonds get lower interest, and long-term bonds, because you fix your money for a longer term, you'll get a higher interest. But they are risk prone. For example, if the interest rates go up, then the long-term bonds will lose value, because in a high interest environment, the buyer will say that I'm getting the same interest for a short-term bond. Why am I going to pay the same amount of money to purchase a long-term bond with the same interest rate, right? Does it make sense? Same thing already happened to Bank of America because we are currently in a high interest rate environment. Bank of America has about $130 billion of hole in their assets at the moment. So if you look into the net profit they made for the past 5 years, that's about $100 billion. The profit made in the last 5 years got wiped out in few months because of the high interest rate environments. So this is a huge risk with banks because they have huge balance sheets, and even a couple of percentage of fluctuation can reduce their assets by a significant amount. For example, they have $3 trillion, right? Even if there is a 2% deficit, that will be $60 billion. This is a risk that is existent in every bank that we know, because all banks have loans and leases and also debt securities as major parts on their assets. Like I said, in a high interest rate or a recessionary environment, these assets will lose value significantly, which can wipe out all the gains the company made or the bank made in the past few years. So because of this risk, Wall Street do not want to pay a higher multiple with banks, because to tolerate a risk, you have to have a discount. and that is what is happening with the banks. And it is no exception for online banks, because they will still have the same risk. Once they get higher and higher deposits, once their balance sheet gets bigger and bigger, they also run the risk of reducing their assets when compared to their liabilities, which can wipe off all the money that they earned in the past 5 or 6 years. So that is the second reason why banks have low multiple. Let's look at Bank of America's evaluation in 2027. In 2022, they made about $94 billion of revenue. And in the most recent quarter, as I said before, they grew their revenue by about 9%. But since Bank of America is already huge, they're growing slow, like in the single digits. I assume 6% growth rate, which I think is reasonable. With that, they can make about $125 billion of revenue in 2027. As I said before, Bank of America has net profit margins north of 30%, but I'm being conservative, so I'm assuming 27.5% net profit margin, with which they can make about $34.6 billion of net income in 2027. With respect to multiple, I am applying a 10 multiple, which is typical for banks, for the two reasons that I discussed in this video. With a multiple of 10, the 2027 market cap would be about $346 billion. Currently, they have close to 8 billion outstanding shares, right? But as we know, Bank of America is aggressively buying back the shares. They make close to $25 to $27 billion of net income, right? So what do they do with that money? They have to buy back the shares. So they're buying back 5% year on year, but to be conservative, I'm assuming 3.5% buyback year on year, with which they will have 6.835 billion outstanding shares in 2027. When I divide the $346 billion of market cap with 6.835 billion outstanding shares, I get a stock price of about $51. Currently, they are trading at $28, right? So that's about 81% gain in 5 years, which is attractive. And remember that they pay about 3% dividend yield based off of $28 stock price, right? So in 5 years, that would be about 15%. So if you add that, that will be about 96%, or almost a 2x in 5 years. So that's why I'm a buyer of Bank of America stock whenever it stays below $30. And I do recognize there are risks, but my evaluation shows very reasonable estimates, and we're still doubling our money in 5 years, which I want. I want my money back within 5 years, and after 5th year, I need to make more money, right? So my motto is 2x in 5 years as a minimum. So Bank of America fits that bill. Then I keep on buying Bank of America. Thank you so much for watching. Please let me know your thoughts in the comments.